Hello everyone, we are Group 7 of Strategy Management course from International Management Institute, New Delhi. The topic of our presentation is Banking Industry Analysis. Here, we will give you an overview of banking industry and then analyze this field with some of the strategic tools that we have studied in the course. So we'll start by giving you an introduction on the banking industry worldwide. Banking industry operates as a network of financial institutions and it offers various services like cash, deposits, credit, money transfer and other transactions. Banks use public money which are deposits to make loan and earn profit from them. These loans can be business loans, car loans, personal loans and mortgages. The banking industry is made up of many small parts like investment banking, insurance industry, commercial banks, etc. Banking sector is one of the key driving forces of world economies and governments. The market capitalization of the global banking sector was 5.2 trillion euros in the third quarter of 2020, which we can see in the bar chart as shown in the PPT. Market cap is the number of shares in the company multiplied by the price per share. In this case, the sector market cap is the sum of this metric for all major banks. Now let us talk about Indian banking sector. The Indian banking system consists of 12 public sector banks, 22 private sector banks, 46 foreign banks, 56 regional rural banks, 1,485 urban cooperative banks, and 96,000 rural cooperative banks in addition to the cooperative credit institutions. As of August 2022, As of August 2020, the total number of ATMs in India increased to 2 lakhs and is further expected to increase to 4 lakhs by 2021. Asset of public sector banks stood at rupees 107.83 lakh crore in fiscal year 2020. During fiscal period 1620, bank credit grew at a CAGR of 3.57% and deposits grew at a CAGR of 13.93%. Credit to non-food industry stood at rupees 102.80 lakh crores as of October 9, 2020. As per RBI, India's banking sector is sufficiently capitalized and well regulated. The financial and economic conditions in the country are far superior to any other country in the world. Credit, market, and liquidity risk studies suggest that Indian banks are generally resilient and have withstood the global downturn well. The digital payment system in India has evolved very well, with India's immediate payment service being the only system at level 5 in the Faster Payments Innovation Index. So that is all from my side. Now I would like my friend Rohit to continue the presentation.
Next, we did a PESTEL analysis of the banking industry. PESTEL is an acronym for political, economical, socio-cultural, technological, legal, and environmental. The PESTEL analysis of a banking sector is used as a strategic tool which helps us to understand various factors affecting the banking industry. Political factors. The banking sector looks all powerful, but it's susceptible to a bigger giant, the government. Government laws affect the state of the banking sector. The government can intervene in the matter of banking whenever, leaving the industry susceptible to political influence. This includes corruption amongst the political parties or specific legislative laws, such as labor laws, trade restrictions, tariffs, and political stability. Economical. The banking industry and the economy are tied. How income flows, whether the economy is prospering or barely surviving during the times of recession, affects how much capital banks can access. When inflation skyrockets, the banks experience the backlash. Inflation affects the currency and its value, and it causes instability. Foreign investors think twice before providing their funds when a particular country's currency value is high. Sociocultural. Lifestyle of India is changing rapidly. They are demanding high-class products. They have become more advanced. People needs and wants are increasing day by day, and this has opened a lot of opportunities for the banking sectors to tap in. Cultural influences such as buying behaviors and necessities affect how people see and use banking options. People turn to banks for advice and assistance for loans related to business, homes, and academics. Consumers seek knowledge from banks regarding saving accounts, bank related credit cards, investments, and more. Consumers desire a seamless banking experience, and technology is developing to allow consumers to buy products easier without requiring direct assistance from bank. This brings us to the next point, technology. Smartphones now can scan and the bank can process it from their end at their location. This change helps to save paper and the need to drive directly to the branch to handle these affairs. Debit cards are also changing. Chips have been implemented, requiring users to insert their card into the debit machine rather than swiping them. Also some have implemented a tap option, tapping the debit card onto the device, requiring no PIN and for transaction to complete. These changes make it easier on the users to purchase without requiring intrusion from banks. Legal. The banking industry follows strict laws regarding privacy, consumer laws, and trade structures to conform framework within the industry. Such structures are required for customers in the allocated country and for international users. The Banking Regulation Act also provides that no new bank or branch of an existing bank could be opened without the license from RBI, and no two banks can have common directors. Environment. With the use of technology and particularly with the mobile banking apps, the use of paper is reduced. Additionally, the need to drive to the bank to handle affairs is minimized as well. Many users are taken care through mobile apps and online banking services. Consumers can apply for credit cards online, buy checks online, and have many of their banking questions answered online or via phone, thus reducing the individual environmental footprints. Next, we talk about the key success factors which are important to future competitive success of the industry members. These factors can be broadly classified into business risk assessment and financial risk assessment. Business risk assessment includes factors like market position, which is a comprehensive assessment of the bank's market share in key business lines as well as its future prospect. The vulnerability of the bank's market position is also considered by comparing its competitive advantage against its peers. Infrastructure and quality of service. This analysis covers detailed assessment on the bank's distribution network, such as branches, ATM, IT capabilities to support its daily banking operations in effort to provide better services to its customers. The bank's quality of service is also diligently assessed, as is it considered as an important factor for retail bank to attract customers and support the bank's sustainable growth, particularly in this intense business competition. The next factor is diversification. This analysis covers the thorough assessment on the bank's business network with regard to its locational spread, business lines, products, revenue structures, customer base of funding and lending, and credit risk. The next is management and human resources. This includes detailed assessment on the bank's quality and creditability of the management, the bank's management strategies to maintain sustainable growth, and the bank's quality in financial planning and structure. This implementation of good corporate governance, particularly accountability of management and transparency of its financial statement, is also reviewed. The next category is financial risk assessment, which includes capitalization. This analysis includes diligent assessment on the bank's capital composition, dividend payout ratio, internal growth rate of capital, ability to generate external source of capital, capital in comparison with assets, as well as the management philosophy and strategy on leveraging its capital. Assess quality. This analysis includes intensive assessment on the bank's non-performing assets and the bank's loan loss reserve policy and adequacy. In addition, thorough analysis is conducted on the qualitative aspect of the asset quality. Profitability. This analysis includes assessment on the bank's net interest income and margin, non-interest income, ability to pay risk into various products, operating profits, and net income. Liquidity and financial flexibility. This analysis covers the assessment on the current market conditions and its effect on the bank's liquidity, examination on the bank's liquidity management, and ability to earn immediate cash flow and its contingency plans to support its liquidity demand. Next, my colleague Aman will continue the presentation further.
Thank you, Rohit. Now I'll be discussing about the State Bank of India. It started as Bank of Calcutta in Calcutta on 2nd of June 1806. It was nationalized in 1955 and was renamed as State Bank of India. State Bank of India is a multinational banking and financial services company based in India. It is a government-owned corporation with its headquarters in Mumbai, Maharashtra. It has 22,141 branches across India, including 191 foreign offices. It is the 43rd largest bank in the world and ranked 236th in the Fortune Global 500 list of the world's biggest corporation of 2019. It is the largest bank in India with a 23% market share by assets and a 25% share of the total loan and deposits market. Now, coming to the mission and vision, its mission are as follows. We will be prompt, polite, and proactive with our customers. We'll create products and services that help our customers achieve their goals. We'll go beyond the call of duty to make our customers feel valued. We'll be of service even in the remotest part of our country. Its vision are My SBI, My Customers First, My SBI First in Customer Satisfaction. Now, coming to the SWOT analysis of the SBI, its strengths are SBI has a separate act for itself, thus, it has a special privilege for itself. Second, it has the biggest branch network in the country, which means it has a very good reach. Third, it is the first public sector to move to CBS. Fourth, it has a good brand visibility and awareness due to the extensive marketing. Now, coming to the weaknesses, it has immense competition, which means it has the limited market share growth for the SBI. Second, its international presence is less as compared to the global banks. Third, the promoters are decreasing their shareholding in the recent years. Fourth, declining net cash flow. The companies are not able to generate the net cash during the recent years. Now, coming to the opportunities, it has to pull in talent to replace the going top management to serve the next generation. Second, SBI can make better use of CRM, technology, and online space. Third, expansion into the rural areas can boost its business. Fourth, with focus on India going cashless, the bank can dominate the market with its extensive reach. Coming to the threats, the consolidation among the private banks can reduce its market share for the SBI. Second, the new bank licenses by RBI can affect its operation. Third, foreign banks that have sophisticated products are a threat to the SBI. Fourth, SBI operations are often disrupted by slow government decisions and red tapeism. Now, coming to the strategic differentiators that has helped in the growth of the SBI. First is the SBI brand, a contemporary positioning at all times. SBI used the tagline, the banker to every Indian, to create a dominant position in the Indian banking industry. This has helped the bank withstand the onslaught of private and foreign banks in the Indian banking industry with relative ease. Keeping up with the modern trends, SBI has now repositioned its brand as a smart bank for the new generation. To do justice to its positioning, hundreds of SBI branches are converting to the SBI InTouch branches that leverage the digital technology and make good use of the digital platforms. Second is the customer comes first. SBI is able to target the youth of today through modern, technology-enabled initiatives. State Bank Buddy is the mobile wallet designed for the tech-savvy generation, the youth of the country. With this Buddy app, the user can do a number of online transactions like mobile recharge, pay utility bills, online shopping, and ticketing, etc. SBI has also launched the mobile app State Bank Samadhan on Google Play Store. This is a self-service app enabling SBI customers to avail a range of services and obtain a commonly sought information without visiting the branch. Third is the specialized products. SBI has developed the specialized products to cater to the needs of the new segments. A pioneering innovative product, eSmart SME for financing merchants selling through e-commerce platforms has been designed. SBI has also taken cognizance of the taxi generators that have been revolutionizing the way Indians commute. It has tied up with these aggregators help individual drivers buy a car and become mini entrepreneurs. SBI has tied up with both Ola and Uber India to extend the vehicle loans to drivers and operators associated with these platforms. Five tie-ups have been launched during the year: Philips, MedPlus Pharmacy, Anytime Fitness, Lakme Saloon, and Raymond. SBI has also developed several new products to target farmers better. The Premium Kisan Gold Card is aimed at financing emerging agribusiness entrepreneurs engaged in high-tech farming and allied activities. Fourth is the managing risk in a proactive manner. SBI believes in spreading its risk by offering advances to a wide variety of customers rather than focusing on a few segments. In order to focus on capital conservation and maximization of the return on capital, SBI has introduced risk-based budgeting. SBI has implemented the risk-adjusted return on capital framework both at customer and portfolio level. SBI has continuously been working on promoting technology initiatives for operational convenience as also to minimize the operational risk. Such initiatives include mobile versions of corporate internet banking, that is, State Bank Anywhere, which allows corporate users to initiate and authorize their transactions through their mobile. SBI also stabilized the LLMS, that is, Loan Lifecycle Management System platform, a web-based portal for assessing the credit risk in loan proposals, including the internal credit rating exercise. Fifth is the engaging employees to bolster the HPS performance. SBI has introduced flexi timing or flexi hour scheme in a limited scale, where the employees is free to select own work hours within the limits laid by the management on the grounds of looking after family and health. Additionally, SBI has implemented a new system of a performance appraisal, that is, career development system of employees in an objective and transparent manner. SBA has taken the several initiatives that are women friendly. For example, summary accommodation has been provided to the female officers up to the grade of the scale 5 for those who are posted in rural, semi-urban and urban areas. Sixth is the operational excellence. Several novel initiatives of SBI have ensured the operational excellence. These include branch mentoring, quick processing, IT excellence, drone review, concurrent audit, offsite transaction monitoring system, audit of outsourced vendors. Now, my friend Arpit will continue further.
Hello everyone. Now let's take a look at HDFC Bank. HDFC is India's premier housing finance company and enjoys an impeccable track record in India as well as in international markets. Since its inception in 1977, the corporation maintains a consistent and healthy growth in its operations to remain the market leader in mortgages. Its outstanding loan portfolio covers well over a million dwelling units. HDFC has developed significant expertise in retail mortgage loans to different market segments and also has a large corporate client base for its household related credit facilities. With its expert experience in financial market, a strong market reputation, a large shareholder base, and a unique consumer franchise, HDFC was ideally positioned to promote a bank in Indian environment, and so they did. The HDFC Bank was incorporated on August 1994 by the name of HDFC Bank Limited, with its registered office in Mumbai, India. The HDFC Bank commenced operations as scheduled commercial bank in January 1995. The bank was among the first to receive an in-principle approval from RBI to set up bank in the private sector as part of RBI's liberalization of Indian banking industry in 1994. The bank at present has an enviable network of over 5,430 branches spread over 2,848 cities and towns across India. All branches are linked on an online real-time basis. Customers in over 500 locations are also serviced through telephone banking. In addition to this, bank also has a network of over 5,000, 15,000 network ATM across these cities. HDFC Bank under Aditya Puri has been one of the biggest success stories of India in the past 2 decades. It transformed a startup in a sector dominated by a state-owned bank into an industry leader. HDFC leads the industry in terms of market capitalization and remains the most profitable by a long margin. HDFC Bank also has one of the lowest NPAs in at 1.36% compared to Indian banking average being 8%. HDFC Bank's mission is to be a world-class Indian bank. The objective is to build a sound customer franchise across distinct businesses so as to be preferred provider of banking services for target retail and wholesale customer segments, and to achieve healthy growth in profitability consistent with bank's risk appetite. The bank is committed to maintain the highest level of ethical standard, professional integrity, corporate governance, and regulatory compliance. HDFC Bank's business philosophy is based on four core values: operation excellence, customer focus, product leadership, and people. Now let's talk about the SWOT analysis of the company. Now, first coming to strength. First strength is a strong existing core banking system across all its branches, which makes the communication easier and makes it much more resistant to fraud. HDFC also has a large collaboration with corporations for employee salary accounts, giving it a large customer base in private sector. It also has several services like online banking, app, mobile banking, and NRI services to its customer, which has created a loyal and happy customer base. It also has few weaknesses. One of the major weaknesses is the rural penetration is low for HDFC as compared to the other nationalized banks. Though the bank is one of the top banks in the country, competition from public sector and private sector means that there is a limited market share growth. HDFC also has less physical presence compared to its competitors. Now let's look at few opportunities of the bank. Improvement in mobile banking and internet banking can be a huge boon for the HDFC business, as it already has a good foot in the business and is ahead of its competitor. Venturing more into rural areas can be done by HDFC as to increase its customer base there. HDFC also provides more complex products to the ever increasing demands of industry and its customers. Now let's see few threats. Competitors increasing their business can adversely affect HDFC business, and their new banking license and regulations can also impact its operations. There's also a threat of foreign banks that are offering better product and much more complex products. Now let's see few of the strategic differentiators for HDFC. HDFC Bank has always promoted innovation and integration of technology in banking sector. SMAC process, social, mobile, analytics and cloud as route for innovation has been major priority for HDFC Bank. HDFC Bank is also the first bank in the country to offer trade finance on mobile. The bank has acted proactively and launched various digital initiatives including Chiller, which enables peer-to-peer payment, and Pays app. It's a new mobile banking app that provides an ecosystem for customer to pay with one click and also shop online. HDFC has also continued to deploy ATM with ATMs outnumbering the branches 3 to 1. This is to increase the self-service banking with aim to shifting transaction from the high-cost branches. HDFC was also an early investor in data warehouse, and over the year has added layers including CRM, risk analytics, market analytics that enable better understanding of the customer. HDFC has been targeting to improve STP, which delivers a significant operational advantage such as low turnaround and response time, efficiency in transactions while reducing the paperwork and human resource input. The key advantage of automated process is reduction in customer complaint, resulting in improved customer experience. Now my friend Anant will take you through technological disruptions in Indian banking industry. Thank you.
Thank you, Arpit. Now we are going to talk about the technological disruptions in the Indian banking industry. The fusion of current technologies such as machine learning and blockchain and emerging ones such as quantum computing could not only create new opportunities but also engender new risks. Additionally, technology will also radically change work as we know it, as well as who is doing the work and where it gets done. Digital disruption and exponential technologies are blurring the lines from an industry perspective, with leading practices and learnings from one industry being applied to other industries. Now we look at some of the technological disruptions which have been revolutionizing the banking industry. First, the blockchain. Blockchain is being widely debated and has become the new buzzword for multiple industries, especially banking. Banks are continuously exploring new ways to perform transactions faster for enhanced customer service while ensuring cost efficiency in their operations and assuring transparency to their customers and regulators. Blockchain is disrupting this system by offering a higher security and lower cost way to send peer to peer payments, one that requires no intermediary. Blockchain technology promises to revolutionize the banking industry by creating a decentralized database of unique digital assets. With a distributed ledger, it's possible to provide services like payments, securitization without the need of a third party such as banks. Though blockchain is a powerful solution, it is still in its exploratory stage, and it comes with its own set of challenges, which include non clarity around regulatory status, integration procedure and change adaptation, and cost. Like any other industry, choosing the right use case is the key for banks to leverage the full value of blockchain. Then we talk about open APIs. An open API is a publicly available application programming interface that provides developers with programmatic access to proprietary software application or web service. Through APIs, banks now have the potential to create an ecosystem of value-added services and emerge as banks of the future. In a quest to create this ecosystem, banking platforms are evolving from a closed to open banking model, which involves shared use of bank products, services, functions, and data with third parties to add additional value and create new business models. Open APIs give banks in India an opportunity to increase their geographical boundaries, create value-added services, and monetize their business assets by partnering with fintech companies, NBFCs, payment banks, and retailers. But the disruption due to API occurs mainly due to challenges embedded in its adoption, which begets many changes in regulatory and existing operational ecosystem. Data privacy regulations have been quite stringent in some of the countries, and factoring them in APIs becomes quite challenging. In India, right to privacy is becoming a prominent risk asked by citizens, and the government is taking a serious look at it. By providing their APIs to third parties, banks are exposed to a greater risk of cyber attacks and can no longer hide their critical applications behind firewalls. Although open APIs give a plethora of opportunities to banks to change their value propositions, banks will need to use customer data in innovative and more individually tailored propositions. Adapting to a digital marketplace also requires more than simply upgrading IT architectures and embracing new technologies. To succeed, banks will need to reshape their organizational structures and cultures to a significant extent, which will inherently disrupt the existing banking ecosystem. Then we talk about the rise of fintech companies. The rise of fintech companies have impacted numerous applications and revolutionized the way consumers access their finances. Its impact ranges from mobile payment apps to investment and insurance companies. This profound impact of fintech can also be seen as a potential threat to brick and mortar style traditional banks. In today's digital era, more number of customers are shifting to services that are quick and safe, rather than depending on traditional banking services. This is the reason why fintech is gaining immense popularity and causing disruption in the banking and other financial services. Fintech startups are broadly focused on concept of unbundling banks, offering one type of product or service and concentrating on doing it very well. The fintech firms have shown that rapid adoption of upcoming technologies such as AI along with machine learning, which quickly alarms the users of any potential fraudulent transactions taking place. The advent of cutting-edge technologies coupled with customers' demand for safe and more user-friendly banking experience has led the banks and financial services to readily adopt financial technology. Many consulting firms claim that changes coming over the next 10 years will be less visible than the global financial crisis or the dot-com bubble, but the impact of these changes on banking, economics, and fundamental business models will be highly substantial. Today, fintech is bigger than ever. It is all set to become even bigger with retail banking software, financial core banking software, and many other components coming under it. And hence, banks have started to adopt the cutting edge technologies and make strategic investments by acquiring many fintech firms. Now, towards the last part of the presentation, Arpit Agarwal will talk about the ways with which banking firms can cope with incumbent technological disruptions.
Thank you, Anand. Now we are going to talk about how to cope up with these technological disruptions. Indian banks leapfrogged into the era of digital revolution and it is moving towards virtual banking. The future of banking is marked by the emergence of new technologies posing a significant threat not just to the banking business but also to the workforce of the bank. The banks are going to face the threat from financial technology firms that are likely to take a specific place in the banking business. Banks need to embrace new technologies not only to compete with its peers, but also with other financial service providers. Such a move is possible only if the banks continuously update the employee skills and address the workforce challenges that arise due to disruptive technologies. First, such a move is think big and scale fast. It is highly challenging to keep up with the changes brought by exponential technologies. Some of these technologies might seem like a buzzword at the moment. However, they are here to stay, and it is a matter of time before they become part of the mainstream. Organizations that have adapted the digital and exponential technologies are rapidly disrupting the traditional businesses. The key characteristics that set these organizations apart are ability to create value through ecosystem, network, and platform-based business models. By being multimodal, that is, ability to manage different velocities of change within the organization, inculcating a culture of innovation by imbibing the principles of fail fast and learn fast. By embracing these exponential and digital technologies, organization will not only achieve growth, operational efficiencies, and customer centricity, but also stay ahead of the competition. The second way to tackle these challenges is architecture to connect to anything. The systems are diverse and they are getting more complex with every passing second. Now, financial institutions will need to layer on a more sophisticated view of federated identity management because companies will be dealing with a new set of users. System architecture can be key to balancing control and accessibility. That is the way the technical building blocks can protect the institution against cyber threats without adding needless barriers to discourage interaction. Few of the endpoints that will need to coexist and cooperate are cloud services, enterprise databases, data warehouses, applications, and systems. The third way to tackle these disruptions is to move towards robotic process automation. According to World Economic Forum report titled Future of Jobs, more than 5 million jobs will be lost to automation, robotics, and artificial intelligence across the globe, and two-thirds of these will be in the office and administrative sector. In most organizations, there are many routine processes performed manually that lack the scale or value to warrant automation via IT transformation, but for which macros and other such desktop automation tools are too limited to effectively address the issues. RPA can fill this gap by reducing the minimum viable scale of process automation as compared to its traditional counterparts. Organizations using RPA solutions typically achieve operational efficiencies, improved quality, cost reduction, decreased cycle times, and improved throughput. Automated processes provide flexibility to change quickly, ability to scale up exponentially, and produce valuable audit trails for compliances. But it is also very important to drill down to various attributes by identifying a process for automation and analyze them from ease of implementation versus benefits point of view. Now, at the end, we will conclude by saying that while the way banking is done changes, banks' role will likely not. Despite what happens, banks should remain true to their core identity as financial intermediary, that is, matching demand with the supply of capital. Banks' competitive advantages should continue to be their ability to manage risk and complex financial matters, conducting business in a highly regulated market, driving innovation to serve client needs, protecting clients' privacy, and maintaining trust, all at a scale. Thank you.